All right. So PRB, if you'll just give me about halfway through, just say, Dr. B, just let's play some mute, baby. Okay.
Sure.
We'll get her going. All right. Welcome in, everybody. Couple of announcements. This is good news, I think. So next week, we will not have any live classes next week because sweet Bobby is on vacation. I cannot wait. Going to the beautiful mountains of Tennessee with the most restless 5 children that you could ever see. And I'm taking my mama too. If you ever get a chance to take your mama on vacation, you always should. We always take mama. She's like, Bubba, well, I don't have to go with you. And I'm like, yes, you do, mama. Yes, you do. And we have a great time taking my mama with us. So we drive a prison van and we all fit in there and we'll have a great time. One of the things that I did during my working career, and I still do it now that I'm retired, is I would try to work 12 weeks and take a week's vacation. I'd work 12 weeks, take a week's vacation. So if you add that up, that all adds up to 52 weeks in a year. So after about 12 weeks, the human body and mind just gets worn out, or it did me, even when I was young. And I would always have to take about 12 weeks. I'd do good working, and then I just had to take a week off. And even now that I'm retired, except for teaching this class, I still do the same thing. So it's so fun to go on vacation, spend time with family and friends, and just have a ball. So I cannot wait for that. So I'll be on vacation, but I still will be available to answer your questions, send your emails and everything. I'll still check those while I'm on vacation. We just won't have any live classes. So do y'all do the same thing? Do you find that after about 12 weeks, you got to have just a week? And even if it's a staycation, you just got to get away. Or even if you go, I don't have 4 weeks of vacation a year, just try to do something in the evenings after you get off work, just something to look forward to. That's what I've always found, because how many people go to jobs that they just can't stand? And then they just go, oh my God, I got to do this for the rest of my life. And that can be a really miserable way to live. So try to build in some fun time that you take care of yourself, you take care of your family, friends. I mean, enjoy yourself. Life is a lot of fun. It really is. And oftentimes we get so bogged down in work and schoolwork and all the drama that goes with it, we just can't enjoy ourselves. So y'all, PRB, speaking of that, my family is headed to Jackson, Wyoming, the last week of this month. Are you going too?
Yeah, luckily.
There you go, baby. That sounds fun. Yeah.
Try to do some ice fishing and some snowmobiling. Should be a good time.
You won't catch this old fat boy out. Don't do no ice fishing. I see it on TV and I go, Tubby does not get on the ice. No. Tubby ain't going under the ice. So hey, have fun. I know people that are used to that are really good with that. So it's just that I don't think that's something I would ever do. All right. So here we go, y'all. Look at the market, y'all. We got a little bit of a sell-off going on. So the E-minis, which is SP 500, is down 1.41%. I was hoping it would be down big today. And I wanted it down bigger than this, but we'll take what we can get. The NASDAQ down 1.86%. And I've moved some money over into an IRA with Thinkorswim. So I think most of this in a regular IRA, and it's about $3,000 or so in a Roth IRA. So I'm hoping to do something with this, and right now it doesn't have anything, right? So there's the money zero. It's just sitting there. It's not doing anything. But I'll kind of give you my thoughts on what we're going to do. But what I want to do today is take just a little bit of time and let's talk about your plan. If you've got an investment plan, what is your investment plan? And let's look at some characteristics of a good investment plan. Characteristics of a good investment plan. And let's just have you guys give us some ideas. All right. So what's some characteristics? Someone give me something. Philip, what you think? What would be an idea of a good investment plan? Philip, can you hear me? You may not can hear me. Okay, you may not can talk. Hit your space bar and it'll unmute you for a second. It won't unmute you? Huh. Okay. Can anyone else talk? Zach, can you talk to me?
Sure.
Okay, Zach can talk. Good. All right,
So
Zach.
I think, really, I mean, for the planning thing that we're all going for here, I think the primary characteristic of good planning is going to be know your audience, right? Know your client, because there's a big difference between the textbook mathematical answer and functionally what's going to be best for their life. And you don't know that until you get to know them.
Yeah, I got that. Now, in my opinion, I'm sitting there thinking, Zach, let's talk about your plan for you though. Now, let's don't look at the clients right now.
Okay.
Because, think about how many people are out giving investment advice who have not covered their own basis yet. You know what I'm saying?
Okay. Yeah.
Do y'all agree with me that that's happening out there? That there's people spouting out investment advice and they don't know what they're doing, right? They don't have their own house in order. So let's work with our own house. So Zach, what you did is really, really good, but let's just talk about for a minute, what would be some characteristics of a good investment plan for ourselves in general? Let's think about some good characteristics.
So I guess for me, I balance my liquidity need so that I know what I have available to invest and what I need to pay current liabilities.
Mm-hmm. Mm-hmm. So are you talking about as far as you got to make sure you have enough to cover your current liabilities and that you're not putting too much away into your investments?
Yeah, I'm saying that. And I'm saying that, and what I am putting into investments that I'm okay with, like the time horizon that I'm putting it away in, so that I'm not going to pull something out at a time that's a bad time to pull it out.
Yeah, because when, you sit there and you see the ski boat, right? And you're like, man, I'd love to have that. And then you look at your 401k and you start thinking, man, I'm going to borrow from my 401k to get my bass boat or my ski boat. Bad decision, right? So you got to know, you got to know the how much can I put away? I mean, I like that. How much? Make sure that, you still got enough to pay your bills. Now, the problem with most Americans is that they don't start thinking about the investment horizon until after they've already got the credit card bills. They got the brand new, 4x4 Ford truck with all the, stuff on it. And, I see these kids, it kills me. They'll post, they brought their brand new truck and how the dealership will post their picture on Facebook. And I just sit there and go, dang, man, what y'all doing? Why are you spending so much money on some of that stuff when I know you're in debt on that stuff? So you gotta, so they're going to debt first, then they think, oh, I need to save for my retirement, I need to save for the future, I need to invest, but they're not able to because they've got all those bills. The bills are what gets us in trouble so many times. Now, I don't like the Dave Ramsey plan of living like a pauper, and what is it? He says eating beans and rice and beans, every meal and all of that. I want people to enjoy their lives and spend and have experiences and a little bit of stuff, but we really need to make sure that we're planning for the future. All right, so that's good. All right, who else has got something? Anyone else?
I think it's got to be simple, Bobby.
Oh yes, I love that, Doug. Very simple.
And
give me an example. Keep just simple, right?
yeah, I mean, like you were talking about Dave Ramsey, for example. He's got those 9 baby steps, right? They're pretty simple. They're pretty easy to follow. The average person can do it. And he's got it really laid out in terms of how much you're putting away for retirement and things like that. So I think the simpler you can make it, the more applicable it is to everybody. So it goes back to your 5 by whatever the index card that we're trying to limit it all down to.
Yeah, keep it really, really simple. Good, Doug.
I think that one of the first things that he does is save up and get $1,000 in the savings and kind of go from there.
Yeah, get your 1,000 savings in case, the brakes go out on the Tundra, right? You got to get those fixed and instead of having to put that on a credit card. Yeah, exactly. Which is good advice. So let's assume we've done all that. We've got our we've got our, 3 to 6 months of living expenses. We've got, this, and that. And now we're really just saying, we need to save for our future. Now, how many of you would say, okay, if I have children, I need to save for their college before I save for their retirement?
No. No.
Uh-uh.
Nope.
Y'all, I hate to say it, but screw the kids, right? Hey,
Mhm.
they can do like I did, and they can work 60 hours a week at a convenience store while I went to college and marched into college band full time, right? They can do that.
You can finance an education. You can't finance retirement.
Can't finance retirement. Exactly, Eric. So make sure that when you're thinking about stuff, you got to be a little bit selfish. You got to worry about you first. And some of you are and will be financial advisors. You got to take care of you before you can take care of your clients. Can you imagine going in and telling your clients to do all this garbage and you go, man, I wish I could take my own advice. Right? So simple is really, really good, Doug. Anyone else got something that you'd add to our little list of we're coming up with our investment plan? It needs to, how much can we put away? It needs to be simple. What else?
I think
not
it's
saying-
also, I think it's also important to know where your accounts are. So how are you mitigating taxes? So I think that's also wise
Tax mitigation. Mhm.
because it's not just about the returns, but also keeping what you've gained.
Right. Because we want to keep the government's claws out of our money. I don't mind paying them what's due them. I just don't want to pay them more than what's due them. All right. And let's see, who else has something? Tracy, do you have something? Brent?
It
This-
was I kind of echoed what she said, or was going to echo, but it's just know what you want your money to do and how you want to get there. Have a specific plan. It can be
Mhm.
simple, but be specific.
Yeah, simple.
I think along with that plan, you have to have goals, like where you
Goals.
want to be like in 5 years or what have you.
Goals. I like that. Another thing that I like, and it kind of goes back to simple, automatic.
Yeah, something with low risk,
So
relatively low risk.
when we look at the automatic portion of it, what do I mean? If you have to write the check every pay period to put into your investment account, chances are there are going to be weeks you're not going to write that check. So when I say automatic, I mean, make sure it's coming out of your payroll, make sure it's coming out of your check as an automatic draft into your investment account. You just got to make it automatic so that you don't have to think, oh, every pay period I got to write a check. Because if you have to think about writing a check, chances are you won't. So make it automatic. Anything else? Now, what else was you saying? Okay, you said PRB said risk, right? You said something about risk.
Yes, sir. Something with relatively low risk.
That one's
Or
hard.
just know your
I
risk
would-
tolerance.
Yeah,
So
I was
risk
gonna say-
everybody
yeah, I like
be
that.
different. Just
Because
know your risk tolerance.
yeah, risk tolerance. Yeah. What's my risk tolerance?
Yeah.
So when you say relatively low risk, I'm sitting there thinking, I don't know about that, man, because I'm a risk taker in the investment world. I love taking risks. Now, what was taking risks? Y'all know what I did. Y'all know that over 30 something years, all I did was put money in the SP 500. I did what Warren Buffett said, probably before I knew that there was a Warren Buffett. And I was doing that. A lot of people would say, well, little old Bobby, you so dumb. You from Ramburn, Alabama, you don't know what you're talking about. You didn't have bonds in your portfolio. You didn't have fixed income. You didn't have this. You didn't have, you just dumb. You just put it into 500 companies, dude. And that's why I told you over a long period of time, diversification is overrated when it comes to a point that, you're not going to have that much exposure to equities. I don't think anyone in here would disagree with me that you have to have exposure to equities, to stocks, in order for your investments to grow. You're going to need some. And now, what is your risk tolerance? Is it the S&P 500? Maybe the NASDAQ? Is it, but I would say that there's people out there that are probably have 5 or 6 stocks in their portfolio and they think they're diversified. I would say the S&P 500 is much more diversified. And I didn't need a bond component to what I was doing because I knew that over the long term that I would be fine. Now, remember we talked about last time, because you're going to try to overcomplicate it. So many people are going to try to overcomplicate it, and you start adding 10 different asset classes to your investments, you're going to underperform the market. You just are. You just are.
But
When
sometimes you're
you
not trying
speak
to
of
beat
the
the
S&P,
market.
do you look at equally weighted? Because when you're looking at those 500 companies, sometimes it's only the top companies that are really getting the assets in them. So
Say that
do you
one more
consider
time.
do you consider the S&P like a fund that is equally weighted across all 500 companies?
Not sure that it's equally weighted. I think it's
No, it's market weighted.
It's
Well,
it's
then you
market weighted,
have you have several different funds though, right? That you can look at. You can have an S&P 500 that is equally weighted amongst all 500, or you could have it market weighted. So that's my question to you.
sure. So I was just basically doing something that mimics the S&P 500, not something that's been tailor made to equally weight them or anything. But so I think if you look at the S&P 500 now, I think it's about 30% tech, isn't it? And that currently the weighting that's in the S&P
Yeah, it's
500.
20, almost 26% right now.
Yeah, about 26% tech. So yeah, I just take the S&P. So if I was in my little regular account, not my thrift savings plan with the federal government, which is the C fund, which was the S&P 500, I'd probably be in SPY totally, or maybe a Vanguard S&P 500 fund. But I wouldn't go to something that was kind of a boutique, messing with the weightings of those 500. I'll just go with what mimics the S&P 500 itself. Now, Eric, you brought up something very, very interesting. Eric, I want you to ask that same question that you asked.
Yeah, it's not always about trying to beat the market. If you have a financial plan in place and you only need a 5% return to succeed, and you're not comfortable with the risk, why take it?
Yeah. And I understand that. I understand that totally. Well, I say I understand it. I understand that some people's risk tolerance will not allow them, right, to go beyond, to try to, and I'm not saying beat the market. I just kind of want to make sure that I'm kind of equal to the market over a long period of time. There are some people, maybe you're correct, that says, hey, look, all I need is 3%, 4%, 5%. And there are safer ways of doing that. Exactly. So I get that. I say I get it. I understand it for other people. I don't understand it for myself, if that makes sense.
I agree with that.
Yeah.
You can also find ways to keep your costs and fees low.
Mhm.
So all things being equal, find something with a low expense ratio or avoid commissions or 12B1 fees if those are still a thing.
Mhm. Yeah, keep the expenses low. So Eric, I absolutely positively do understand exactly where you're coming from. And that's great, right? Because people are different. People are absolutely different with risk tolerance. I think it's a great point. I guess I'm the one that, I kind of look at what the S&P does and goes, gosh, man, I'd really like to at least kind of keep up with that, right? I'm kind of competitive, or at least get that type of return. I understand why there are some that don't want that. For example, it's hard for me to understand people who, now don't beat me up on this, guys, okay? It's hard for me. I see these people who are so excited about their dividend portfolios. Oh, they're just excited about building these portfolios with these great dividend paying stocks. And they're so happy because they're getting income from the dividend. And I look at it and I go, oh my gosh, what a horrible plan for someone that's worried about the income from dividends. And it may be someone in a total different life stage than I am, but what they're doing, why does anybody know why I don't like stocks for dividends? Anybody know or would think why I would say it's not for me?
By the time you're getting a good dividend, there's not a lot of growth left and less volatility.
Yeah. So, Apple forever didn't pay a dividend. and then they had so much cash that they started paying the dividend. So what I like to see in the companies that I would be in, those SP 500 companies, I'm much more concerned about them growing and putting that cash, into new businesses, into new arenas, into new areas, doing something with it. I don't want to see them returning money to their investors, because at that point it becomes more of a safe company like AT&T. It's always going to pay the good dividend. It's always going to do this. And people get so excited about the dividends. And I go, okay, you're paying your dividends out, you're limiting your growth. And that's just my assumption when I see that. So I'm not here to build a portfolio that I go, wow, I've got all these great dividends coming in. I understand people are in different situations. They want the income. They want their stock portfolio to be, blah, 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 to not be too volatile. And they like those nice returns. I get it. It's just not for me. Anything else that we need on our investment plan?
Let me ask you this, Bobby. I don't know if this is where you're going with this, but we talk a lot about growing and investing. What about protecting that growing investment with insurance? That's something that I think a lot about. As a CPA, I've got errors and omission insurance protecting my assets from, mistakes there. And just in general, everybody's got liabilities every time you step out the door. Don't we want to protect all this nest egg that we're working so hard for?
Oh, absolutely. Absolutely. We want to protect it. And like, for example, there are ways that I invest that help protect my investments as well, not from the purchase of insurance, but I actually go into the marketplace. And Zach, you've been in enough of my classes to know that I'm doing different types of hedges and things that pay off in the event of, big calamities in the stock market. I told you about March 2020 when the doctor, I'm at his office and he's about to tell me, look, dude, I'm gonna have to cut your toe off. And I'm like, oh crap. And then the market was going haywire in March 2020, and you're not supposed to have your phone in the doctor's office. And I said, Doc, give me a sec. I've got to close my positions, dude. I love this. I know you're going to cut my toe off. I know all this. I got to go to the hospital, but I got to close them. And he looks at me. He said, oh, man, I understand. He said, I bet you're taking a big hit today. And I said, well, not actually. You won't believe this, but I'm up over 200% today.
Did he give you a couple grand to manage, or?
No, he didn't actually. I think people, when I wear a spam hat in the doctor's office, I think they think that I'm local, cuckoo loco or something. I don't think that anyone believes me, right? There's like, so he was like, whatever, dude. And so I closed my positions and my hands were trembling. I never experienced insurance paying off to a tune of an entire portfolio, doubling, in a day. So
Well, there's the insurance though too. You went to the doctor and got your toe cut off and probably didn't get a huge bill for that.
yeah, I'm the most insured person on the planet, no doubt. Look, I've got the long-term care insurance, I got the disabilities insurance, I got the life insurance, I got it all. I got dental insurance, I got the health insurance, I got what is it, Beth and I have? We have the long-term care insurance. So Beth is covered for life if she has to go into a long-term care institution, a nursing home or a rehab facility. She's covered for life. I've got 5 years of coverage. Then you got to think, what is the average stay of someone in a long-term care facility? You look it up, it's under 4 years. So I've got 5 years of coverage there. So I'm the most insured person. I'm a big believer in insurance and covering risk. And if you were to look at me in any other aspect other than investments, you would say, wow, you've got your risk managed in a lot of ways. So yeah, that's good.
It may not belong right here on the board. I just thought it was worth mentioning.
Yeah, it certainly is. Certainly is.
Hey, Bobby, I got one more thing for this, and I don't know how to put it in a bullet point, but
Sure.
I think it's got to be built for all types of market conditions, and it's got to be more of your philosophy, right? Because you can build it for what the market looks like today, but then as things change, if you're always chasing what the market's doing, like in the shower this morning, I was dreaming about if I put $10,000 in that TQQQ, what I'd be doing today. And so you get what I'm saying? It's got to be something that you're going to follow for 40 years or 50 years. It's got to be built like that.
Yeah, absolutely. Absolutely. Because, how many of us could have could have done that. And held through some of those, you know, held through some of those times. I mean, it is kind of cool to look at. And you do look back though, and that's why I like trying to automate things as much as we can to take my emotions of fear and greed out of it, and the fear and the envy of looking at someone else and saying, well, they were able to make great fortunes in Bitcoin and cryptocurrencies. So, and I look at them and I say, I don't know why the asset appreciation occurs in those cryptocurrencies. So crypto is not part of anything that I want to invest in. I don't care that people have made fortunes in crypto. I don't understand it. I am a boomer, I guess you call me, right? They call me boomer. Boomer doesn't understand. I don't understand. I get the blockchain, I get all of that. But as I look at it, I go, I'm not sure what it is that makes the demand for it grow. Well, more countries are adapting cryptocurrencies, more blah, blah, blah. And I hear all of this, and it will be the new reserve currency. It will be the new currency. And I look at that and I go, when was the last time I got excited about currencies? Now, I have traded the British pound. I have traded the euro. I've traded currencies, and not once did I ever get excited about a currency. So I understand it's bigger than currency. It does all this kind of stuff. Hey, but I don't understand why there is increased demand for it. When I look at the S&P 500, I can see why companies such as Amazon are providing goods and services to the public. I understand how that works and why there's a demand for that service, because when you know your FedEx and UPS driver by first name basis, because you see them every day, because every day they're bringing something to your house, I get where that's going. So, you know, but crypto may be something for you. It absolutely may be something that you are very comfortable with and something that you want to make as part of your portfolio. Hey, let's add this here. There's always a little need to put a little fun money in there too, right? Now, remember, I'm not a big proponent of buying individual stocks, but perhaps in your investment plan, maybe you're allocating 5 to 10% as that lottery ticket. Just a little bit that you go, man, there's this one stock. I want to put a little bit of money in it. And if you can put just a little bit of that, so that you don't gamble on the 95% of your portfolio, it's okay to put a little fun in there, a little speculation, little speculative funds towards something. So very, very, very good. Let's also say this, y'all. The most important thing most people don't do is put it in writing. And this is something that can change as well, you know. So I'm asking you to write your investment plan and do it on a simple sheet of paper. But you need to say, I, Bobby Gaines, hereby swear that I'm going to put $200 every month or $500 every month into blank, 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 blank. I'm going to rebalance or reallocate. In other words, you're going to look at it once every 3 months, 6 months, a year, and you're going to, you know, tinker with your asset allocation. And this is my plan. Now, that doesn't mean that 6 months in, you can't say, oh, I forgot of something, or hey, there's something else I want to. Your plan can always change, but it's important that you, on a 3x5 or on an 8.5x11 piece of paper, have this down somewhere on your phone, in notes, in somewhere where you go, this is my plan. And my investment horizon is 20 years, 10 years, 30 years. And here's what I'm going to do to fund my investment plan. Now, it may be different. You may have a plan for your Roth IRA and a different plan for your margin account. You may have a plan for your 401k that's different from, you know, from your other account. So, you know, but in general, what am I going to do specifically over this next year to 5 years to build up my wealth? What gives you the most chance? And remember last time, here's what I love telling you last time. It's not the stock picking. It's not the stock picking, as we say in Ramburn, Alabama. It's not the picking, it's the asset allocation. Here's where you make money. It's asset allocation. So I know that my asset allocation has to be in equities, primarily, if I want growth. Bond and fixed income, is that a part of where I am now? Perhaps, right? Fixed income. So our plan needs to be in writing. It needs to be, what asset allocation am I comfortable with? If yours is cryptocurrency and you think that's going to be the next big thing, go with it. Anything else you think that we have? Oh, time for midway teams. Yeah, let's take a little break here. Let me pause. So why was that Angie's favorite song? Anybody? You know, I think this is the ironic part, you know, when we realize how she, you know, passed. I hope you still feel small when you stand beside the ocean. Whenever one door closes, I hope one more opens. Promise me that you'll give faith a fighting chance. So in life, there are a lot of different times where we are going to give or get opportunities to sit it out or dance. And I love this. I hope you dance. I hope you dance. So, you know, you see Philip up there with his little boy, holding his little boy. That's what's important, right? That's what is important. It's the families and the friends and the relationships and our kids and our parents that are important on taking a chance on. So, you know, dance. Now, sometimes I dance out in public, right? I mean, and it embarrasses my kids, and I'll skip to my loo and do whatever. And Beth will even say, stop it. But you got to dance. You got to enjoy the spot, because guess what? We're all going over the cliff. We're all going over the cliff called death. It's just a matter of time. Doesn't matter if we're a baby or we're an old fart. We're all going over that cliff sometime. So when I'm coming up with my investment strategy, I'm not sitting here wanting to be behind a screen all day. My kids will be home in, you know, another 30, 40 minutes, and I get to spend time with them. I get to spend time and go with them to their ball games, to their practices, to awards night. Devin had an awards night, and some of my kids don't participate in anything, but I'm still there for them. And so that's what's important. You and I never want to be to a point that we're just sitting behind a desk and not engaged in life. It's worth living. Life is worth living. It's worth getting out there. It's worth taking chances. It's worth taking risk. So my risk tolerance with investments is really, really high. But at the same time, I don't take those same risks with my family, so to speak. I make sure that I'm there, right? One of you made a really good observation in one of your things when we was talking about acquiring wealth and getting wealthy. And tell me who it was. I can't remember, but you were like, it doesn't impress me someone driving up in, you know, a Ferrari or BMW or whatever kind of car it is. That doesn't impress me. What impresses me is seeing someone who is able to spend quality time with their parent, with their children, regardless of the amount of money that they've got. That's what's more important than all the money put together. And all of this is just side stuff. I mean, you know, we can never let this take over the small stuff, because it's that small stuff that's the good stuff. So you don't want to sit behind looking at screens all day and the markets and all that. You want to have your plan in place. That's why, you know, we have wheels, right? How many of you don't have a wheel? You've not done the proper planning so that you can sit back and rest and know that if something happens to you, that your children, your dependents, your spouse is taken care of. So we take care of our plans. We put our plans into motion. We come up with our investment plan so that we can sit back and let it work while you and I are focused on things that are much more important. And that's the loved ones that are around us. Philip, that's your grandson. Well, you do look extremely young. So you understand the mistake exactly. It really ticks me off. Honest God, I can't tell you how many places we go, and y'all see what I look like. I'm a wreck every day, right? And I've tried to color my hair with rusty almond, and it just doesn't work. And so the gray comes out, and I barely got any hair. And regardless where we go, it's like people think I'm best daddy, and I wouldn't. She just gets such a kick. What, Beth? I talk about you. That's why I turn around. She said I'm guilty because I'm talking about her. But anyway. Anyone got any questions or anything about that? Any comments about the song at all? All right. So I kind of want to tell you what I'm going to do, what I'm thinking about doing with this. Oh, and here's what I want you to start doing. I want you to be kicking around your investment plan, what you're going to do. Like, so, mine would say, no stocks, indexes, blah, blah, blah. I want you to start kicking around. And I want you to start playing in your portfolio. Y'all asked this the other day, can we make some trades in our portfolio? Absolutely, you can. I want you to start doing some different things, right? I want you to start trying to build a portfolio. What would you do with your $100,000 account that is hypothetically given to you? Would you go all in on something, or would you dollar cost average into something? And that's an interesting thing too, right? Because there are proponents of lump summing. There are proponents of dollar cost averaging. I think the statistic I read is about 66% of the time it's better just to lump sum into something rather than to dollar cost average. Can't remember where I read that, so don't quote me on it. But what would you do with your $100,000? I want you to start kind of making some decisions. What would you do with this $100,000? Now, I'm kind of going to tell you what I'm going to do with this one. So let's go back. Let's look at what we've got available. So this
If we lose all of our money, do we fail the class?
You do not fail the class if you lose money. If y'all cannot tell by now, and maybe it's because of my worldview of, life is more important than grades, and it's more important than assignments and killing you and causing your life to be hard. And see, the great thing is you respect that. So every one of you so far has done a wonderful job of doing your assignments, even though I'm not trying to kill you on your assignments. Do y'all see where my life view comes from? Because it's much more important that you learn than you pass an assignment, or that you get it's more important that you are here mentally with me. And I can tell, if you're here mentally, because you're participating. And I'm not here to cause you ruin. I want you to learn. But if you sit there like a log and don't learn, that's not my concern, really. I don't want to cause you. I don't know. I think our education system is so wrong. We just look for grade output, and our kids leave our schools not knowing anything. So hopefully you'll leave this class at least with your mind broadened a little bit and going, hey, wait a minute, this stuff needs to be simple. It needs to be automatic. Simple, automatic, and no stress. Your investment should never be stressful. Now, some of you said, hey man, that buy and hold really beat the heck out of AIM. But yeah, but at the end of it, if you had the cash that you were holding in AIM, that is zero stress. And if you had held that cash in March 2020, that's when you would have gone in and said, ding, 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 I need to buy in, because the market just went down 35%. There was a 35% drop, I think, in the S&P 500. I'm going in. So it's less stress. So here's what I'm going to do. Here's what I'm thinking about doing with this portfolio. I've given it a lot of thought. If I write this down, does anybody know what this is? Anybody recognize that? Nope. Okay. This is a little acronym, and it's called Hedge Fundy's Excellent Adventure. Hedge Fundy's Excellent Adventure. And I'll get you some reading on it. I want you to read on it, okay? Excellent Adventure. So, does anyone know what a boglehead is?
Someone
ahead.
that likes indexes, index
Yeah.
funds.
Yeah. So and so they're kind of running like Mr. Bogle does. You know, they kind of say, yeah, index funds, low cost index funds are the way to go. Well, Hedge Fundy was or is a boglehead, and he's a member of the Boglehead Forum where they talk about the low cost everything. And he proposed something that I think has a lot of merit. Now, keep in mind that this is much riskier than you just putting money in the S&P 500, right? Into SPY and dollar cost averaging into it. But it's something that, I don't know, I kind of like. And I kind of, with my high risk tolerance, I'm going to try. So we'll try this, and I'll throw it out for you, and I'll get you some reading resources to see what they kind of did with this. But what Hedge Fundy's Excellent Adventure and his little pursuit of what he was going to do with his money is this. I do like leveraged ETFs. I do. And they're not for everybody. They're probably not for the majority of you here. But what I'm thinking about doing with this account is doing what Hedge Fundy kind of tested and back tested. And he put 45% of his portfolio into a triple leveraged bond fund. I think that is the 20-year treasury. And that is a little ticker symbol known as TMF. Right, so he's putting 45% of it into bonds, basically. This is a 3 times leveraged 20-year treasury fund. So let's say bonds, the bond fund went up 1%, this would go up 3%. If bonds went down 2%, this would go down 6%. It's 3 times leveraged. Then Hedge Fundy put 55% into equity. So he's got some in bonds, and then he goes in and he decides UPRO would be an appropriate place for his money. And this is a 3x leverage S&P 500 fund. S&P 500 goes up 1%. This goes up 3%. SP goes down 1. This goes down 3. All right, it's just leverage. And so what he did, or he is doing with a small percentage of his net worth, is he's done what is called the HFEA, the Hedge Fundy's Excellent Adventure. I kind of like it because what I like about it is it's simple in that it has 2 asset classes. It just has bonds and it's got equities right through the S&P 500 on steroids, of course. So he's taken this and what he does is he doesn't use Lucello's AIM or anything like that, but he does the same thing. Remember last time I told you that Lucello's AIM is nothing more than a rebalancing scheme or device to rebalance the account. So what he proposed and back tested was that rebalance the account every 3 months. So on the quarters. All right. So what I'm thinking about doing, and I may even do it today, is go into that account since UPRO is down, what, if the S&P is down 1.5% or whatever it is, then UPRO's down, what, 4.5%? My math, I tell you, I'm terrible. We'll do 55% of that and put the rest of it into the bond fund. And just see where it goes. I mean, just update it every quarter. I kind of like that. It's a hands-off approach. It's not money that I need or I will need anytime soon. So I'm thinking about just letting that go in a buy and hold fashion other than the rebalancing. And does everybody know what rebalancing does? So let's say we get at the end of the quarter, at the end of March, and now I'm 60% of the account is in UPRO and 40% is in TMF, the bond fund. Well, what does that mean? Well, that means that this outperformed this. So I would be selling 5% of this. So I would be booking winners and buying the loser. So my allocation would be selling the winner to rebalance and buying the losing, so to speak. So I'll provide you some written information on that. It's probably nothing that any of you guys will be, but I want you to be aware of some of these different things, that there are people out here that have back tested different strategies. And let's just kind of see if we could do it in Portfolio Visualizer. And this is not perfect by any.
And Bobby, that TMF in that scenario necessarily isn't even losing. It just did not, being a bond fund, it didn't perform as high as the S&P 3 times did. So you could actually have winners in both, just your balance gets off, correct?
Absolutely. Yes, I probably said this. So let's see, let me go to Portfolio Visualizer. Let's go to back test. Now, remember, when we're back testing, we're doing recency bias. What's happened in the last 10 years, we expect to happen in the next 10 years. So we can, by back testing, we can basically, shoot ourselves in the foot. It doesn't mean that what has happened in the past will happen again. But let's see what would have happened if in 2010, when I think TMF started before 2010, but what year did UPRO start? I think it had to be around the time TQQQ. So let's go from 2010 to 2022, include year to date, yes. And let's see, we've got 116,000 in my account, right? So let's see what we could do. Cash flows, none. We're just going to let it ride. We're going to rebalance like hedge fundy did quarterly rebalance, and let's put in our tickers and see how this looks. It's just kind of fun to watch, right? So let's go UPRO. We're going to do 55%. TMF, we're going to do 45%. There we go. And we can compare that to a benchmark Vanguard 500 index. So that looks like, yeah, let's just kind of see how it looks. See what would have happened had we done that. So, cool beans, right? Again, I know we're looking at recency bias, maybe a confirmation bias. We're looking to see what we want to see. I think it's kind of cool to look at how that portfolio would have performed. So if we just started with $116,000, we'd be at 3.7 million today. That would be a compounded annual growth rate of 33.4%. Best year was 73%. Worst year was 14%. But here's what I like about it, y'all. Watch this. The maximum drawdown was 19%. Now, we've not talked about Sharpe ratios and Sortino ratios, and we will at some point. But basically, the higher the ratio, the less risk in the portfolio. So basically, we see that a fully S&P 500 index fund had a larger drawdown over the last 10, 11 years than did this portfolio. And Sharpe and Sortino's were lesser, and the compounded average annual growth rate was significantly less for just being in the S&P 500. So we can see the two little, little things of how it worked there. So I really, really like that. Again,
is that without addition, Dr. Gaines? Is that without additions added to the portfolio?
Yeah, that's no additions added to the portfolio at all. So it'd be kind of cool, right? So what if we had this? I guess we could say, now let's go cash flows. Let's go contribute a fixed amount, and let's go $500. Contribute fixed amount, inflation gets, no, we want inflation adjusted. And let's do 500 monthly, pretend like this was a Roth that we had, right? So let's put 500 a month in it. So we'll maximize our Roth IRA. We'll still do the rebalancing quarterly. Let's just see what this portfolio would do with that. Really good, right? So Now we're up to 4.3 million, still got the 34.95. Yeah, but I mean, I think you look at it and you go, wow, it's a really, really nice portfolio. And the bonds seem to level it out a bit rather than, you know, having 100% in the S&P 500 fund. So there are all kinds of things out there. There are all kinds of great minds out there, and we just have to be open to listening to them and looking at back tests and looking at potential things that can allow us to maximize our returns. And again, I think hedge fundy is using, 10% maybe of his investments in this. So it's not a ton. And would I be willing to do this with 116K? Absolutely. Absolutely. And just let it run and adjust it quarterly. So it'll be kind of fun, I think, to see our portfolio, if we get that humongous drop in the UPRO, right? If the market's down 20%, you're going to take a little bath, but we would anticipate during those times that the bond fund would pop up and to help alleviate. But I love that, the maximum drawdown of 19.52%. What if? It'd be fun to see another portfolio, wouldn't it? Be fun to see how that would have worked with the TQ. What if we've done TQ at 55% and TMF at 45? So in other words, all you're doing is replacing the UPRO with TQ. Let's just see what that would have done. With this again was with the 500 a month. So see how that one looks. Yeah. Sure, I've got them all right here. Let's see, monthly 500, 55, 45, 55. UPRO TMF, TMF, TQQQ. What is that? $5.8 million on portfolio 2, which would be the red portfolio. It's just kind of interesting. And that one had a max drawdown of 24%. So, all kind of different things that you can do. You just have to figure out what your risk tolerance is. And again, here's what I want you to do. I want you to begin the process of building a portfolio in your paper account. What is it you're going to do? And listen, do not, you don't have to follow my advice of don't do individual stocks, only do index funds, blah, blah, blah. You don't have to do that at all. If you want to buy Apple in your fund, do it. If you want to do, Facebook, it got beat down, you think it's coming back, do it. Do it. I just want you to do what's comfortable for you. But I kind of like you to start going in and making those decisions in your portfolio so that we can take a look at that. Also, I want you to kind of keep watching your short puts that you've got on. How are they doing? And again, we're going to talk about managing those early, what optimal management is. We'll keep telling you about options as we go along. We've got a lot of good things to cover. You will have some video viewing for next week. So if you want to do that while I'm on vacation, you normally do it during lunch. You'll have about an hour video to watch next week. That'll be really, really good. Some of you've seen it before, but it should be good. Any questions at all on what we're doing or what we're thinking, or any questions at all?
I have kind of a conceptual question about the triple leveraged ETFs.
Yeah.
So if you had, let's say you had a really long time horizon, like 25 or 30 years, if the long-term trajectory of the market is something like over 30 years, it gets an annualized return of 4 or 5%, why wouldn't everyone who had that time horizon be invested in a triple leveraged fund if they were going to get triple that amount?
So the cool thing about the triple leverage fund is that the actual returns are greater because the triple leverage fund resets every day. So in other words, if you're looking at a year and over the year, the S&P is up 5%, it's very reasonable to think that UPRO would be up 15%, but that's not the case because it resets daily and mimics the underlying SPY like UPRO does, daily reset. So, you know, if it's up 1% today, this is up 3%. We actually need to put some numbers in there to see it, but because it daily resets, it doesn't seek to mimic the return over a period of time. It mimics the return 3 times on a daily basis. Now, that's you also asked a great question, Kyle, and here is one thing. If you simply Google, can I hold a leveraged ETF long term? All you're going to see is no, 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 no. And they're going to tell you that there's something called volatility decay, that these instruments were not meant to be held long term. Okay. So what that does is the people that go out and look at it say, okay, well, I'm just going to put my hands up. I do not buy into the volatility decay. So in other words, if UPRO, let's talk about volatility decay. If UPRO goes down 50% today, it started at 100 today and it goes down 50% one day. So now it goes down to 50%. So that's a 50% loss, right? It's gone down a 50% drop. Now, here's what everybody says. All right, what kind of return would UPRO have to get back to 100?
100%.
100%. So that scares everybody off, right? So they're going, wait a minute, it went down 50, but to get back to where it was, it can't go up 50. If it goes up 50, it's up to 75. So it's got to go up 100%. This is what they refer to as volatility decay. And this is why the establishment says that these can't be held long term. Now, with that in mind, I think that it is reasonable to find some systematic way to go into it so that you're not putting all your eggs in the basket in one day, right? But that you're strategically going in. I think you can do quite well with triple leverage ETFs. But if you ever go to a job with a financial advisor, Eric Birch, CFP, Eric, if you brought this into the people at your office, what would they say about you?
Well, before I was independent, we couldn't even offer it at JP Morgan. Couldn't hold them.
Right. So, you know, people would laugh. They would, you know, make fun of you. They say, oh God, you can't do that. Then they go Google it and they say you can't do it. So, you know, what I would say is there are tools that can be used. And should you put a significant portion of your assets into it? We showed you the 10-year millionaire plan when we first come in. If you had zero today and you could put 500 a month into TQQQ, dollar cost average in, would it be a good investment? No one can tell you that. Would it be a risky investment? Yes. But over the course of 10 years, what was the maximum amount of money that you would put into it, assuming that your 500 was even over the next 10 years? $60,000. Based on what we've seen, would anybody be willing to, I don't want to say gamble, but how many of us would say, okay, let's try it. Let's see if we start with $1. Let's do it again. We put in $500, no rebalancing month, no rebalancing. We're just going to put money in and we're going to go into TQQQs. Let's see how we do. And we go 100%. Take everything else out. Would you be willing to risk $60,000 for the potential to make what's that say, 145? Here, analyze portfolio. Here we go. To make $1.4 million. Oh, Bobby would. Let me tell you something. If I was 20 years old, fresh out of college, had my brand new job, then I go, man, I'm gonna max out my old Roth IRA 500. So you can't do 500. Can you do 200? Could you do that? Would you try that for a maximum output or loss, if it all went to zero, of 60,000 for the potential of 1.4 million in 10 years? Oh, heck yeah. I'm in, baby. I'm in. All right, questions about anything? You guys are doing so great. You guys are doing great. I hope you're getting a lot out of the class. You getting something out? More things you want to say? Yeah, well, I'll show you how to trade natural gas. Showed you how to trade, crude oil, all kinds of stuff. But just keep it simple. That's what I want you to come out of this class. I want you to go, good Lord, life is great. Life is fun. I need to spend time with my family and friends. I don't want to spend it behind a screen all day. I want to have a meaningful life where I contribute to my family and society. And I want to do something passive in the background that has a potential to set me up, set me up really, really nice when it comes time for me to retire. That's what I want you to have. Because retirement is really fun. It's a lot of fun. Questions. And I don't want y'all to be 95 years old when you retire. All right. If there's no questions, I will see y'all not next week, but the week after.